Hey traders, welcome to Charts and Coffee. Happy Friday, everybody. Happy PCE Friday. We had the inflation data come out kind of flat. If you took a look at the hot zone and if you were trading it like we were in the Sector Secrets Master, you noticed a few things. Month over month, year over year, depending on PCE or the core, pretty flat, slightly hotter, but not really blowing out the forecasts to the upside. So not super surprising in the aftermath of it to see a mildly bullish response because it was marginally hotter than we would have wanted to see. But here's the bottom line. Is this going to be a bullish catalyst for intraday today? Probably not. We'll see how the 9:30 response is. But if we take a look at where this really lands, and this is it. This is the CME Fed Watch tool. And this has now had about 30 minutes to digest those PCE numbers. Now, remember, the PCE is the data that the Federal Reserve uses in terms of inflation for their models. They don't use the CPI, right? And so when I look at September, now look, is July really up for grabs? Some folks say, hey, we could cut in July, but that's not untrue. But let's add the rest of the data in and say, look, it's a 6.7% chance that we cut in July versus the overwhelming 93+% that we will not, right? So yes, it's there, but not probable. Now, what's probable for September? The cut. It's fully baked in, right? 89+% expectation for the cut. This 10%. Does that mean folks are thinking half point cut? Not really. This is just the rollover from the slight expectation for a July and September cut, but it's still very likely that the first cut will come at the September 18 meeting and it will be a quarter point. And so today's PCE has not altered that, although we will see where we close today in terms of the end of the week and a full session to sort of digest PCE, but rate cut expectations have not varied. Now, remember, they don't meet in August, but we're still going to get data in August. So this could incrementally change as we go into September. We're going to get some data in September. By the time we roll around to this meeting in September 18, we'll already have received our non-farm payroll numbers, 2 of them actually. So remember, the jobs data does matter. Non-farm primarily. JOLTS, I would say, also pretty important, but the Federal Reserve has a dual mandate. It's not just their inflation target, it's also employment. All right, so that is where we are post PCE. And if you have any questions, as always, feel free to type them in. And we are rocking some coffee for Charts and Coffee. All right, so there we go. So let's get to it. So what will we expect from PCE at this point? You know, there's been a lot of discussion about Dow and Russell, rotation, things like that. And here's the way sometimes it just makes sense to think about it. In the first half of the year, NASDAQ and S&P were historic. I mean, that's not even really hyperbole. It was historic. We hit all-time highs consistently, what seemed to be constantly. We climbed for the first 6 months of the year, with the exception of April. So super bullish first half of the year. Now, it's interesting that the lethargy kicked in as we went into the second half of the year or at the end of Q2. Rotation is not predictable. You know, I watched an interview with the guy from Neuberger Berman, Eisen. He's known for The Big Short. And I loved his interview because the first thing that the television commenters started off with is, you saw this coming, right? 90% of the guests go, oh, yeah, please, right? I loved how honest he was about his assessment of the market. It was refreshing, like a glass of lemonade. And he brings up a really good point. Rotation is going to happen. We can say that if there's going to be rotation out of tech and out of S&P, yeah, who's going to benefit? Likely the other two lagging indices, the Dow and the Russell. Do we know it's going to happen? No. Do we know when it's going to happen? Well, again, we can reduce it down to certain windows that it could happen, but we don't know if it will. So at the end of Q2, sitting at all-time highs, at some point, and it could be just this arbitrary. Remember, these are people. I know everyone wants to say that the algos and the machines are running everything, but they're still being programmed by people. And at some point, people decided, I don't want to build on higher highs in the NASDAQ as I go into the second half of the year. What is on sale and still has 6 months to possibly rally? And that's how sector rotation works. Do I want to keep buying higher highs in the S&P and the NAS, or at the second half of the year, are we going to now see the Dow and the Russell a little bit more favored? So please don't always look for logic. I mean, and I guess it depends on whether or not you think human beings are logical. We're really not. We're really emotional. And we can just make decisions because we feel like it, like New Year's resolutions. Why not make a resolution in October? No, we make them in January. So if you think about certain cutoffs, end of quarter, second half of the year, right? Those are oftentimes when those kinds of decisions will be made. And that just happens to be what's been done. So Dow and Russell continue to be favored. Now, the question I'm getting a lot of, and I appreciate the question, is in terms of tech. I'm going to leave tech alone, gang. When tech rallies would then take attention away. I remember my husband and I did motorcycle road racing school, and the book that the class was based on is a book called Twist of the Wrist by Keith Code. It's such a great book because it's not just about motorcycle racing. But one of the ideas in the book is that your attention is finite, right? So you've got $1, right, in terms of attention. So you can think about it as 100 pennies, 4 quarters, 20 nickels, 10 dimes, however it is you think you can divvy up your attention. But at the end of the day, I know this: attention placed here on the NASDAQ and my trying to find a relative outperformer, which, by the way, we did a little bit of that work. I never want to be unprepared, but we did a little bit of that work yesterday in the Sector Secrets Mastery to say, well, if the NAS does start to at least find a floor, start to base a little bit, find a bid, right? Find a floor, what could benefit? And there are about 6 names that we narrowed it down to, just 6. 100 stocks, 6 of them looked pretty decent for maybe if the NAS just kind of levels out, these could start to outperform because they are outperforming relative to other NASDAQ stocks right now. And, you might be wondering, Rog, for instance, Apple, Oracle, right? So any attention placed here takes some of my finite attention away from what is working right now. So that means I want to focus on Russell. I want to focus on Dow. I want to focus on financials, healthcare, regional banks. So that's where, for now, my attention will be until the NASDAQ shows signs of settling down. And I'm not going to sort that out on a Friday, right? I'm not going to do that on a Friday. I would not expect at the end of the week, all of a sudden, everyone wants to rally the NAS and take it back into, say, even neutral behavior from the bearish behavior that it's in right now. So I never worry about when that's going to happen. The timing on that is impossible, right? So David asked, wasn't the sector rotation fueled by September rate cut expectations? I think a lot of people are going to say that, but David, here's where I'll say no, and only because I'm going to talk my book. If you want to go back to last quarter, the quarter before that, and even the quarter before that, end of last year, and catch any charts and coffee, you're going to hear me talking about one thing and one thing only: S&P NAS and the rate cuts that were expected in March and May. That benefited S&P and NASDAQ. So we've been expecting rate cuts for almost 10 months, for about 10 months. And for the most part, up until this month, the S&P and the NAS were beneficiaries of that. So no, I don't think suddenly the rate cut narrative that pushed S&P and NAS to all-time highs and then all-time highs and then all-time highs again, right, is suddenly now being placed on Dow and Russell. I really do look back and say at Q2, traders, investors, money managers said, I don't want to keep buying this. How much more upside really is there? And the Dow and the Russell are lagging. And that's kind of how sector rotation works. Take profit in the outperformers and take those profits and funnel them into something that isn't in the penthouse, something that maybe is only on the first floor and has the ability to grow into the second half of the year. because that's where the report card is. Think about folks who manage money. The report card for them is, hey, this is what we did this year. So their cutoff is the end of this year. And every quarter there's a bit of a cutoff. Every month there's a bit of a cutoff, but none more so than how did you perform this year? So traders will say, I don't care, right? I agree. I don't care how I'm not presenting my results to anybody, but there's a huge part of the trading population who does have to present their results to clients in terms of this is how we perform for the year, whether or not they outperform the S&P, et cetera, right? So there are those decisions that are made, I believe, based on looking at the second half of the year and saying, do I want to keep buying this thing at all-time highs, or do I want to start buying Dow and Russell? Do I want to keep plowing into tech, or is it time to start looking at healthcare, financials, energy, industrials, transports? And that's going to disproportionately benefit the Dow. Our regional banks, something we want to look at now, that would benefit the Russell. So everything likes low rates, right? I know there's an argument out there now saying, oh, but regional banks and Russell likes low rates. But for the first 6 months of the year, it was the S&P and the Nas that did. So be careful, because I find every now and then I turn on television and it's their job, I get it, to entertain and keep us tuned in. So we watch their ads, but they're always going to have a reason for something. That's why they're there. But it doesn't mean the reasons make sense. And I don't think it makes any sense to say that rate cuts in September are suddenly now going to benefit Dow Russell any more than rate cut expectations that were originally in March, May weren't benefiting, right? The Russell and Dow. Sometimes it's just where our attention is, because our attention is finite. Even the market's attention is finite. So where the attention goes, the money flows, right? Okay. And we've been bullish on the Russell. We've day traded it. We're looking at regional banks, and I'll continue to trade what is versus what was. And that's probably the hardest part of it, saying, but the S&P and the Nas did this, past tense, right? They've already done it, and they're not showing signs of it now, because when you look under the hood, those tech sectors, those NASDAQ sectors, semiconductors, technology, communications, consumer discretionary, they're definitely lagging things like financials, regional banks, healthcare, utilities, industrials. So the sector behavior is distinctly different as we kick off the second half of the year as opposed to the first, right? And those are observations. I think that they're still very much, sadly, and I blame television 100% for this. And folks have bought into it because they realize that's how to get attention. Let's predict where things are going to go. I don't know where things are going to go, right? So the less I put the pressure of prediction on my trading, the better off I'll be. And we're reactors. We react. We're counterpunchers. We see the shifts and we make adjustments. So that's the way I've always looked at it. All right. And, it's like halftime. It's a football game. First 2 quarters are done. We're in halftime. The coaches went back to the locker room and they came out with a different game plan. I mean, that's literally what happened in the second half of the year. It's like the 15-minute halftime in football. All right. Next up, Ren asks, do the green, yellow, and red lines represent moving averages? Not solely, no. I mean, they're definitely a type of moving average. I have a different calculation. We look at not only price, but participation. All right. But generally they are based on moving averages, but it's not the traditional 34 EMA wave that I use, but it's a variation of that. It's a variation of that. We adjust, well, back in Q1 of this year, we introduced something called the top tier. So it was taking the tools that I had been using for about 30 years, and we evolved them because some of the demands that placed on you and I in modern markets is very much participation. It's not just price. There's 4 factors, by the way, that move the market. Price is clearly the most important. But then ask yourself, volatility. Are we moving within the typical 68% probability of volatility? Are we moving outside of that? Volume, how much participation is happening at a certain price? And then, of course, time, right? It could be time of day for day traders. It could be certain cycles within the month, like your pit bull low to your OpX. It could be economic events, different hot zones like non-farm in today's PCE. And then during earnings season, of course, we're going to see the tail wags the dog season where an individual stock can have a disproportionate effect on the broader average. So lots of different things, but 4 factors: price, volatility, volume, time. All right. Moving on. Let's see. Due to the market personality today, should I change my trading strategies from swing to day? Eddie, here's what's interesting. Every day, I wake up and look at the markets and look at all the symbols that we trade, futures, stocks, ETFs, and I just try to find what has been moving without a lot of gaps, without a lot of wiki crazy volatility, what's moving within the price movement ranges. I just try to find some normalcy because things moving outside their probability and things moving inside their probability makes a difference between a certain amount of expectation, right? Okay. So then, I'll give you a great example. Yesterday, and it's seldom on my bingo card, right? Yesterday, if you would have told me that in the Sector Secrets Mastery, we would have bought IWM calls, and those would have been the Grand Slam winner on the day, that just wasn't something that I was expecting. I try not to expect anything. So some days, I'm always going to look for swing trades. The swing trade time horizon is days, if not weeks. So I can do that every day. Day trading can vary with every single day and the clarity of that day and the message, the news, the events, the earnings, the data of that day. But I never try to presume. I just try to stick with repeating the process with risk management. And if the process is undergoing or it's going to be exposed to a environment undergoing a lot more volatility or shifts, we'll just naturally not get an entry. But yeah, if you would have told me yesterday we would have bought IWM calls at $1.58 and rode them up to 355, I would have never have thought that. That was the big winner yesterday. So I do both every day. There'll be times I might want to do a more conservative version of day trading. There'll be times that I want to do a more conservative version of swing, but I'll always keep those processes running. I'll always keep them running unless we're running into an environment that we say, hey, it makes sense to tap the brakes on one or the other. And it's very difficult to predict, Eddie. Yeah, it's super difficult to predict. So I try not to. Again, if I have to think about prediction, then I'm in big trouble. So that's the way we navigate the markets together in the mastery. All right. MELI for longer term. Well, for longer term, that to me, we have an entire portfolio of ETFs and stocks. We just call it the position portfolio in the mastery. So we've got a track record there of what we've done on the weekly. And when I see weakness like we're seeing on the NAS, I definitely want to go shopping. And that will likely be something we will do going into next week, maybe even today. But weekly to me means a typical hold of 6 months or greater. So it really depends on what long-term is defined by specifically, right? To a day trader, an hour chart is a long-term. So I've got to know what that means. But in general, if I look at the daily, right? If I look at the daily time frame, yeah, I have no issue. If you're looking at Melly, maybe above 1600, that Darvis there, as long as we're in the bullish hemisphere, which is above the equator, those white dots, we are. I would look for the long side, but as far as a longer term hold, unless I really know what you're thinking, years or months, but I would say anything on the weekly above 1550 is still in bullish territory. Yeah. All right, gang. So as always, thank you so much for being here for Charts and Coffee. I appreciate it. The show's been going on for about 3 years now, and I love kicking off the morning with y'all. Thanks, as always, for the questions. And I think I've caught up on them. Let's see. Oh, and what does a swing trade mean? David, yeah, thank you from the Essentials Room. A swing trade just means overnight. And I know Bot got you there, but just for those of you also listening in, yeah, what do I mean by swing? I just mean a time horizon of 1 to 3 days. Typically I want overnight, but I'm not going to rule out we might hit our target. Yesterday, we put on a swing trade for TJ Maxx. And we hit our target. So it doesn't mean that I'm going to say, oh, but I want to keep it overnight. I won't take the trade off the table after hitting the target. No, we just happened to hit the target that day. So go figure. But usually swing simply means overnight. Yes. All right, gang. Thank you as always. I'll see you on Sunday for our Top Tier Outlook show at 6 p.m. Eastern. Same time, whatever channel you're watching me on now, I'll be back at 6 on Sunday. Be good to each other, gang. I'll talk with you soon.